We help very large multinational companies, Fortune 500 and other very large multinational companies, save money by reducing their energy use and reducing their carbon emissions. By really offering a bespoke solution, we present the opportunity to them, we design it, engineer the project, we manufacture the equipment when we deliver it with guaranteed savings and a fixed price.
I'm your host, Kyle Grieve, and I'm here with the CEO from Thermal Energy International, William Crossland. William, thank you for making time for the viewers here and talking to us about Thermal Energy International and what you guys are up to right now.
Hi, Kyle. Thank you for giving us the time to tell our story.
Excellent. So for the people watching who might not be familiar with Thermal Energy International, could you give them a brief description of the business?
Absolutely. So our reason for being, thermal energy, at the end of the day, we help very large multinational companies, Fortune 500 and other very large multinational companies, save money by reducing their energy use and reducing their carbon emissions. And we do that by really offering a bespoke solution, a turnkey, total end-to-end solution for our customers. We present the opportunity to them, we design it, engineer the project, and we manufacture the equipment when we deliver it with guaranteed savings and a fixed price. And so quite frankly, our customers use us because we're the quickest, easiest, and most importantly, the lowest risk way for them to reduce their carbon emissions and reduce their energy use and start saving money as soon as possible.
Excellent. And so with some of your products, I know you have multiple lines of products. What would be your top product that you've been selling?
Yeah, that's a good point. I should have mentioned everything we do, the big turnkey projects we do, everything we do is based on our own proprietary technology. And all of that technology is centered around thermal energy efficiency. Most people, for whatever reason, when they think energy efficiency, often, consumers think light bulbs and windows and things like that. And on a residential building or even a commercial building, about 50% of the energy that's used is electricity. The other 50% is thermal heat energy, usually natural gas or some other fuel they're using for heat. With our clients, industrial clients, that's pulp and paper, pharmaceutical, chemical companies, 90% of the energy they use is thermal energy. It's a fuel that they're burning. That's what we focus on. We're helping them reduce the amount of fuel. Only 10% of the energy they use is electricity. So if they want to meet their carbon emission reduction goals, the most important thing for them to do is address thermal energy efficiency. And that's much more difficult than the electricity. On the electrical side, they can buy green energy right off the grid. With the thermal side, it's much more challenging. And so when you think about it with energy efficiency, first of all, most of these, 90% of the energy used is thermal, and they use that at less than 50% efficiency. 50% of that energy is just, going right up the stack. We recapture some of that heat that's being lost, and we give it back to them in a form that they can use it. So all of our technologies, we have 10 different technologies that we use to do projects with. They're all centered around improving thermal energy efficiency for our customers.
Great. So one thing that really interests me about your business was how visible revenue is due to your backlog and your paid development agreements. Can you detail these two areas, how they interact and how they eventually end up as revenue?
Absolutely. It's an important point, Kyle. So thanks for highlighting it. I mentioned that much of what we do are bespoke solutions, turnkey, designed for that site and for that application. So there's some engineering that's required up front. Often with our big projects, they start out with a project development agreement. So we will visit a client, and based on our experience, we know the types of sites and the type of industries that can definitely use our services. We'll go to them, we'll ask them a few questions. We'll spend, a day or two gathering some data, and we'll go back and we'll come back to them with a value proposition. Say, look, we think based on our preliminary analysis, as an example, we think we can maybe save you $1 million on your energy bill, and it'll cost you $2 million to do that. Is that something that's of interest to you? If they say, yes, that's great, let's do it. We say, well, wait a minute here. We haven't done all the detailed engineering yet. That's not a fixed price yet. That's just an estimate. But I'll tell you what, you sign a project development agreement with us, and, we'll go back and do all that detailed engineering. And if we come back to you with a project that meets the criteria that we both agree on up front, maybe it's a 3-year payback, maybe it's, $1 million worth of savings, whatever that criteria is, you'll either do the project with us or you'll pay us for the engineering. So most of our big turnkey projects are preceded by a project development agreement. And on average, it takes about, from the time we get the project development agreement to the time we get the order is about a year. So there is a year there, and every project development agreement, caution people, every project development agreement doesn't result in a project, but most do, because we don't want to be in the business of engineering. Then once we get the order, we execute the order. Most of the revenue is sort of 6 to 12 months after getting the order. I mean, we'll start working on it right away, but we get deposits up front, but most of the revenue comes in the final sort of 6 to 12 months. And so right now, we're pretty excited because, as you said, we do have a fair bit of visibility. Our year end is May. So for the year ending May 31st, 2024, we just announced our results a few weeks ago. We had a record level of order intake, $27 million, which was, again, up 133% compared to last year. Our order backlog now is higher than all of last year's revenue. And so that order backlog, like I said, usually turns into revenue anywhere from 3 to 12 months after the orders come in.
Excellent. And so if we were to look at your order size, what's kind of like an average number? Like from crunching the numbers, 2 million seems somewhat reasonable. Would that sound reasonable to you?
It's pretty close. So, but just so you know, I mean, we sometimes, most of the time, it's a big turnkey project. And in that case, 2 million is probably about the average. And $1.5 to $2.5 million is about our average. And, we've done projects as high as $11 million in the past. But there's some, smaller ones that might be $1 million. But also the other side of the business, and it's an important side. Sometimes the customer just wants to buy the equipment, just wants to buy the technology. Those tend to be smaller ones. And simpler projects, they can just install it themselves. Historically, that was about 30% of our revenue. Recently, because of the pandemic, it's been a much higher percent because that part of the business continued to grow. But that's an important part. And that part of the business revenue is much quicker. So it's sort of 3 to 6 months, whereas the turnkey projects are more like 6 to 12 months. So obviously the order size on the equipment is smaller. So those tend to be sort of 20, 50,000 to a couple 100,000. Whereas the big projects tend to be, $1 million and up.
Gotcha. Makes sense. And so for those custom projects, because of the lower, obviously it takes you a lot shorter to make the product. Does that get added to your backlog, or would that not even make it onto the backlog?
It would until it's on the backlog, depending on when we ship it. So if we get the order right at the start of the quarter and by the end of the quarter, we've already shipped it, then it wouldn't be in the backlog. But the backlog basically is all orders that have been received that haven't yet been turned into revenue. So it would be part of the backlog, but wouldn't stay on the backlog nearly as long.
Gotcha. And so I remember, I can't remember the presentation, but I thought I saw one that said that you were currently around 25 PDAs. Yeah. Does that sound about right now?
That is, yeah. Last year, that's again, 150% higher than last year. 150% higher than, pre-pandemic, and we haven't talked a lot about it, and I don't want to bring up the negative, but the pandemic was difficult for us for sure. But we were generating record results pre-pandemic, and we're still 150% higher than we were our record results before the pandemic.
Let's just talk a little bit about the pandemic and how that affected your business, because you guys were doing really, really well before the pandemic, and then that just kind of had some downside for you guys. So can you give us some highlights on that?
Absolutely. It's important for people to understand that part of the business. So I mentioned, for the 5 years running right up to just before the pandemic began, so the 5 years ending February 29th, 2020, we had more than a 30% compound annual growth rate on revenue. We had $25 million in revenue, and we had, I think, almost $3 million in EBITDA, almost $2 million in net income. Then the pandemic hit. I mentioned the two parts of our business were turnkey projects and custom equipment. Turnkey projects, by nature, of course, requires extensive travel all over the world, a lot of site visits, a lot of time spent on site. Custom equipment, much less so. Still a little bit, but much less so. So what happened when the pandemic hit is all those big turnkey projects, our customers were scrambling, trying to figure out what to do. So they had no interest in pursuing those. There was site lockdowns, there was travel restrictions. So the big turnkey project business basically fell off a cliff during the pandemic, starting in March. We even had projects that were midway through us completing, actually installing, and the customers orders off site for 6 months till we could come back, so they could figure out what this all meant. The good news is the other side of the business, the custom equipment business, continued to grow at about 30% compounded annually throughout the pandemic, such that, for the last year, it's probably reversed. 70% is custom equipment, 30% is turnkey. But the turnkey is coming back stronger than ever, as we knew it would, as I mentioned, with sort of 25 project development agreements signed in the last 12 months.
So just looking a little bit more at market size, from your presentation, it shows that you penetrated approximately 5% of your top customer sites. What are the main roadblocks that you think you will encounter on your way to increasing this penetration rate?
It takes quite a bit of time to develop the relationships. Everything we do is almost everything we do is a sole source. I mean, that we work in partnership with our customers to develop projects that meet their criteria on a sole source basis using our own technology. It takes a long time to develop that sort of trust and that sort of relationship such that the customer is willing to go, and expand the relationship and grow it aggressively from site to site with somebody on a sole source basis. So it takes time to develop those relationships, but we're seeing that accelerate for sure. We've been in the business a while. Customers weren't interested for the last couple of years. We're less interested in reducing carbon because they were trying to deal with the pandemic. Now, everybody around the world is much more of a laser focus on reducing carbon. Energy prices are much more volatile than they used to be as a result of a lot of political situations around the world. So our customers are trying to eliminate that risk, reduce their costs, and we're the solution. But the answer to your question is it just takes time to develop these relationships, and it takes time to develop large turnkey projects. I mean, it's probably a 2 to 3 year cycle from point where you're selling it to pitching it to them to the point where you're revenue. And that really hampered us during the pandemic, because in the pandemic, when things were canceled, you have to start again at that 2 to 3 year cycle. So we're just sort of ramping up now. The important point about the pandemics, we did not reduce staff. We kept the team. We have a very capable and skilled team. The last thing we wanted to do is lose the team, and then have to start again after the pandemic was over. We knew the market was going to come back stronger than ever. We believed it would. Quite frankly, we didn't think it would take 3 years, but we knew eventually we'd come back. We wanted to be ready to hit the ground running when that time came, and it appears the time is now.
Excellent. And so, in terms of continuing to develop these relationships with your customers, how does that look like in terms of, hiring new staff? Is it, getting more salespeople, or how do you continue to develop those relationships?
Well, to continue to develop the relationships and develop the business, grow the business, it really is salespeople and engineers. That's really, what we are. We're a technical company. We outsource the manufacturing of all 90% of what we sell. So most of our company is salespeople and engineer. Most of the salespeople are also happen to be engineers because it's a technical sale. And so it's growing the team. I mentioned during the pandemic, we didn't want to lose anybody because we spent a lot of time and effort developing the team, training them. It's very hard for us to hire people off the street because they're not going to know our product. They're not going to know our technology. So it takes quite a while to train them. So adding new capable staff is always been a challenge for us. And, we'll continue to work very hard at that.
Excellent. So looking at some of the market forces in your current market, who do you think are your biggest competitors, whether that's private or public companies?
Yeah. Well, as I said, we work on a sole source basis, so we don't really encounter much competition. And to be quite frankly, I'm not aware of any direct competition. We have 10 different technologies, and there is some companies out there that might manufacture a piece of equipment that's similar to ours, but we rarely run into them. And there's nobody that we're aware of that offers a total turnkey package like we do. We just don't run into that. So often, first of all, as I mentioned, when we pitch a customer, they often don't know the opportunity to save the energy exists. We're telling them what we could do. If they wanted to do something like that on their own, they'd have to hire an engineering company to develop and design the project. Then they'd have to source all the equipment. Then they'd have to, retain somebody, hire someone to install it all and put it all together. Multiple points of responsibility. If something goes wrong, everybody's going to be pointing each other. So what we sell to the customers and what they love about us, why I said we are the lowest risk way for them to execute projects, is because it's a single point of responsibility. If it doesn't work the way it's supposed to work, there's only one person responsible, obviously, and that's us. And that is a real advantage to our customers.
Yeah. So you mentioned a couple times about risk with your products. Obviously, with heat and everything, that can be super dangerous. So How do you guys, I mean, have you ever had any types of event with your products, and how does that kind of work? Just, I'd love to know more about that.
There's no, I would say it's the technologies themselves are low risk. There's always risk in every business, but it's not, there's no risk in the technology, either from an ability for it to work or for personal injury. So, we don't really have that sort of issue at all.
Excellent. So in terms of macroeconomic forces, how do they affect your customers' CapEx spend for purchasing your products and services?
Yeah, we're in the fortunate position is a lot of our business is food and beverage. A lot of our business is pharmaceutical, both of which are not cyclical. In fact, food and beverage could almost argue is counter-cyclical. People, they want to drink more beer, drink more soda, and eat more potato chips, I think, when times are tough. So there isn't really a lot of economic recessionary risk in our business at all. We don't believe. In fact, often it's if there's a slowdown, that's when they have time to look at these sort of things. And in terms of other macroeconomic, it's energy prices, obviously, fuel prices can impact us because everything we do is based on a return on investment for our customer, which is primarily driven by fuel and carbon. Having said that, more and more of our customers will tell us the payback almost doesn't matter anymore. It's how much carbon is this going to reduce? We're selling food and beverage companies, pharmaceutical companies, all of whom are selling to the consumer, to the direct end user. They've advertised very aggressively about their carbon emission reduction goals. They have to meet them. They don't have a choice. So it almost becomes, not a return on investment issue. They have to figure out ways to get their carbon down because they've told their customers, they've told their shareholders, they've told the government that they will do it, and they have to do it. So as a result, we are seeing return requirements get less onerous for our customers. It used to be, several years ago where we were competing against every other capital project. So whether they wanted to put in a new line or expand the building or they want to do energy efficiency, it all came out of the same capital pot. What we're seeing more and more now is that there's a separate pot for carbon and energy reduction. So we're not hampered with that. And we're also seeing that the paybacks they're willing to require are going up. So that's an easier hurdle to get across. So all the macroeconomic forces right now seem to be in our favor. That's why we're seeing unprecedented growth.
Excellent. And so for the CapEx spend, let's say, Pepsi, for instance, wants to put a certain amount of money into their carbon reduction. So when they talk to you, they would know, I guess, going in that, sure, we're gonna expend this CapEx now, and we're not gonna actually see benefits for, let's say, 2 to 3 years into the future once the projects are done. Does that sound about correct?
They see benefits as soon as the project is as soon as it starts up. So 1 year. So 1 year in the very first year, the day we commission the project they will be saving energy. But you're right, from the time we pitch them, the time we actually have completed the project installed might be a couple years. So yeah, that would be an accurate statement.
Awesome.
You talked a little bit. Yeah, I'll go back to something you talked about market potential, and this is something we have disclosed about. First of all, about 60% of our business over the last few years has come from our top 10 customers, and 80% of our orders are repeat orders with our existing customers. We're always, sometimes we'll half jokingly say to our sales team, we don't need any more customers. We just need to sell more to the existing customers. But of course, I'm always interested in new customers as well. But the important thing is, we have penetrated of those 10 customers. We've sold in many cases, just a small amount of product, in some cases, big projects, but we've penetrated about 100 sites. And initially people would say, well, 100 sites, you've done 100 sites. There can't be much opportunity left with those 10 customers, except that those 10 companies have 1,000 sites worldwide. And so I would estimate even with our top 10 customers, we're less than 5%, have less than 5% penetration. So there's a massive market out there. There's virtually, in any industry that's using heat, which is almost every industry you can possibly imagine, could use our services. And globally, it's less than 50% efficient. So, the global opportunity is massive. It's almost a meaningless number. It's so huge. But even within our existing customers, within our best customers, we're probably less than 10% complete.
The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. To break out of the treadmill of slaving away each week only to have nothing left over, watching the savings you do have get eroded away by inflation's vicious bite, or freeing yourself from the corporate grind, requires that you master the conversion of time into value. To help you do this, we created a list of 4 simple steps to take control of your personal finances and life. You can download it for free by clicking the link in today's description. Let's say with those top customers, when you go into one of their manufacturing areas, sometimes they're only partially penetrated in just one area. Is that correct? Where
That's right. Yeah. So we might have sold one little often we can have multiple technologies in one site. So then we might have sold just one area, one technology for sure. So, there's very few sites where we're 100% penetrated. That has done everything we could possibly do for it.
Excellent. And so let's say let's say Kellogg's, for instance. I know you guys do business with them. So if you're in one Kellogg site, what kind of work do you guys have to do to then get to another site? Because I know a lot of these sites, obviously they're under the same umbrella corporation, right? But there might not necessarily be talking with each other about their thermal energy savings.
Yeah, there's been a real change there over the last few years, the last 3 or 4 years, pre-pandemic. So you're absolutely right, Kyle. Previously, we had to go from site to site and sell each site. And there was a joke in our company because we have, our base of operations is Europe and North America. And we would go to one company and we had done a site in Europe and we'd go to the site, person in North America and we'd say, well, we did this, had this great success in Europe. And they'd say, oh yeah, but our steam is different. North American steam is different than European steam and vice versa. And that was always a challenge. We had to sell and almost had to start again from square one with each individual site. And and each individual site had their own budget. So the real change that we've seen with many large corporates now, just in the last few years, is that's all being driven at a corporate level with a corporate sustainability VP. And so you still have to convince the site to work because if you get absolute resistance from the site, they're not going to do it. But by working with corporate, they will tell us which sites they want to work on next. They start to understand our technology. They know where the good sites are. And also they often have budget themselves. So they have corporate budget now. It doesn't come out of the site's budget. It's corporate budget. You're now dealing with someone, previously at the site level, we were dealing with someone that was responsible for the profitability of the site. There's lots of different ways you can improve the profitability. Now we're dealing more and more with somebody at corporate whose responsibility it is to reduce carbon. And so we help them achieve their goals. They tell us, they assist us, tell us which sites to go for. They have budget to do the projects. So it's much, much easier. In fact, just in the last 12 months, it used to be more often than not, you still usually get separate orders for each site. But just in the last 12 months, we've had 3 or 4 cases, some of which we had press released where we have been able to get multiple orders for multiple sites all at the same time. And that's all by developing that corporate relationship and working on the program with them.
Excellent. So now that your business has returned to profitability the past 2 quarters after the pandemic, there's obviously more money for the business to reinvest back into itself, especially with your backlog being where it is. So where do you see the best opportunities for deploying that capital that you're going to be having access to in the future?
Growing our business, and that means more salespeople, more engineers, and probably at this point, because we have lots of strong orders and a good pipeline building. It used to be that we needed the ratio between salespeople and engineers was sort of 1-to-1. We're now seeing that, change because, the salespeople are able to sell more. We're getting better known with our customers. The project sizes are increasing. So, we need to hire more engineers and more salespeople, and we'll be doing that. We have hired some more the last couple of months. We added 2 people in France. And a couple of people in the US. We've added engineers in both North America and Europe. So it really is people. Like I said, we're a technology business. And and it's a technical business. So it's adding skilled people. And that's the main area. Not to say we wouldn't be interested in acquisitions. Acquisitions have been part of our growth. We started out with one technology. We now have 10. And there is other technologies, complementary technologies that we could sell our customers, because our goal has always been to, sell more customers, more sites, more projects at more sites. And so to do that, you add the technologies. So we are always looking for acquisitions as well. The last couple of acquisitions have focused, on technologies. So the next couple, maybe we focus on distribution, but we're always looking for ways to increase sales and increase technologies.
Excellent. So how do you decide what the best use of capital is? Is it just like glaringly obvious that just pumping money back into the business is the best use of capital compared to, say, buybacks or dividends?
Well, yeah, I wouldn't dismiss buybacks. I probably wouldn't do dividends. We have done buybacks in the past, but there is a limit on how quickly we can grow, because as you've got, if you can't double your team and be able to train them properly, it just doesn't work that way. So the first is to add to the team and grow, then acquisitions, and then finally, buybacks. We were not shy to buy back stock when we have to, and we have done that in the past. But everything we do is based on internal rate of return. So we do IRR calculations. The most obvious, thing is growing our people. But even when we grow people, we do an analysis on how quickly we think we can pay for itself, or what the return on investment is.
Excellent. So, and then just going back to staff growth. So, you mentioned that you basically didn't get rid of anyone during COVID, which is excellent. Since the end of COVID to now, how much staff do you think you've added?
You know what? I don't know the number off the top of my head, but I know the last time I looked at it, we weren't any higher than pre-COVID. So we didn't get rid of anybody, but the staff did go down a little bit. There was some natural attrition over 3 years. You would expect that. The last time I looked at it, we were just back up to where we were pre-COVID, but we've hired a couple of more recently. So we probably are a little bit higher, like 2 or 3 people higher now than we were. But that's very recent than we were pre-COVID. And, again, that the 12 months ending February 29th, 2020, when we were generating $25 million in revenue. And the other data point that I'll talk to you about, Kyle, because you asked about the order backlog and the order intake and as a predictor of revenue. So just to help your listeners a little bit, in fiscal 2029, we had $22 million in orders. That was a record for us, $22 million. That $22 million in orders in fiscal 2029 is what drove us to $25 million in revenue for the 12 months ending February 2020. For fiscal 2023, we had $27 million in orders. And so far this year, we've already got $10 million in orders, since the year began. So, that gives you a little bit of a way to look at what the outlook looks like.
Excellent. So looking a little bit at current capacity levels. So I know you said that you outsource a lot of the manufacturing. So does that capacity levels, I guess, just doesn't matter that much for you guys, or how does that work?
It doesn't matter as much. I mean, everything always matters a little bit, but the if there is a bottleneck, any bottleneck would be in our own people. It would be what we're doing. Because you're right. We tend to have, a couple of suppliers for everything we do. So usually, there is no issue with that. It's really, do we have the team to be able to execute all the business? And that's the most important point.
Excellent. And so with your suppliers, I assume, do you have multiple suppliers that can source the exact same piece of equipment for you guys in case, you have one that went down? Or
we try to have 2. Yeah. We try to have 2.
In your company documentation, you said that you want Thermal Energy International to be, quote, the best-in-class provider of return on investment-driven thermal energy, efficiency, technology, and solutions to the industrial, institutional, and commercial sectors, helping our clients around the world improve their bottom line, move towards sustainable operations, and reduce their environmental and carbon footprint. So what do you need to do to continue doing, right now in order to cement this status for the business?
Everything we've seen so far is we are best in class, not only from the technology standpoint, but from the project execution. So, we just have to keep executing the business plan. We spend a lot of time developing a strategy, back in 2018, 2019. And that strategy really had 3 pillars. Number 1, it was to grow our account base, add to our technologies, and grow organically, and through acquisition. And that really is what it is. We want to be able to sell more products to more sites around the world. And we want to do that and grow that capabilities both organically and through acquisitions. And so we have to just keep doing that. We think we've found a good formula. It drove us to 31% compound annual growth over 5 years. We're happy now that the market is back, and we want to see if we can exceed that.
Excellent. So do you have any short-term, medium, or long-range goals that you can share, to do with, say, revenue or backlog, PDA growth, employee growth, or market share that you can share? Like, how do you look at that?
Yeah, I have them, but not that I
Gotcha.
can share. No, we're pretty cautious that way. We don't like to give forward-looking information. We always think we want to prove ourselves. And so certainly our goal is to continue growing at the rate or above the rate we have in the past. The strategy isn't going to change much. There was for 3 years, we sort of had to put ourselves on hold. No matter what we did, we couldn't get it going. That's all changed now. So we think we're back at it, and we want to try and accelerate that growth. And a lot of that is going to come, the acceleration of the growth is going to come from, improved corporate relationships, more corporate focus on reducing energy and carbon, and the volatile energy prices, especially in Europe, as you can probably imagine. So, for the last several years, we've said that Europe's going to outpace North America. It hasn't yet. It still tends to be about 50-50, but we still think that time is coming. We think there's energy prices are much higher. Carbon emission reduction targets are higher in Europe. So we're focusing a lot of our efforts on growing, not just in North America, but also in Europe.
So one thing I remember looking at with your business that I kind of found hard to grasp at first until you explained it more was the fact that energy prices going up actually decreases the payback time for your customers. So can you go over just kind of like a little case study to the audience to help them understand how that would work?
Well, yeah, at the end of the day, what we save is energy, right? So obviously, if energy prices are higher, our project is going to pay for itself that much quicker. So, if at current energy prices, it's $1 million and it's a 2-year project, it'll pay for itself in 2 years. So, but obviously, if energy prices increase by 50%, it's now $1.5 million in savings, and it pays for itself in 1.5 years. So, yes, so that's it. But you have to be careful not to sort of look at the daily price, because we're dealing with large multinationals. They have strategic plans. They have long-term forecasts on energy. So everything we do, every payback we calculate for our customers, it's based on their estimated costs. We say, what do you want us to use? And a lot of what's having impact now is while energy prices, went way up, natural gas prices went way up, came back down. They're trying to eliminate that volatility and that risk as well now, not just the price. That there's that factor. And number 2, as I mentioned, just reducing carbon on its own, is important. And it's tough to explain that, but you can, there's a couple of examples that I sometimes use in some of our presentations just to sort of highlight the impact on the price of carbon. And again, the price of carbon varies in every province you're in Canada, every state you're in the US, every, country you're in Europe. But to give 2 examples, we did a North American cereal company, a project, and they estimated that the payback from carbon alone was about 7 years. So the reduction in carbon would pay for itself, pay for the project in 7 years. With energy, it's even better. Then another project we did in Europe, it was about a $900,000 project. The savings from energy alone were $300,000, so about a 3-year payback. But in the market where they were in, they were able to get $400,000 credit upfront based on the carbon that the project was going to reduce. And therefore, their net cost goes from $900,000 down to $500,000. So it's, less than a 2-year payback. So carbon is becoming more and more important, not only from a standpoint that the customers has their own goals to reduce carbon, but from an economic standpoint as well.
William, thank you so much for joining me today and sharing your thoughts on Thermal Energy International. For any viewers who enjoy discussing stocks such as Thermal Energy International in a lot more detail with other like-minded, fundamental-focused investors, please check out the TIP Mastermind community at theinvestorspodcast.com/mastermind.
There has been a lot of investors from all over the world, actually, that have been interested in knowing more about Teqnion and investing in Teqnion. But we have very little free float. There is very little stock that is trading every day, which I'm happy about because I think it means that we have shareholders that are interested in being part of this long term rather than speculating and trading over our reports.